Welcome back, Breakaway Wealth. I'm Jim Oliver, your host, and with me today, my co-host, Nick Kosko. Welcome, Nick.
Hey, thanks for having me again. It's fun going through this book.
It is fun going through this book. Now, this chapter is chapter 5, and we're talking about how does this work, economics of IBC.
All right, hold on. What are we talking about? We're talking about the case for IBC. Those of you that are just joining us for the first time, Nelson Nash put out a few published works talking about infinite banking concept. The last one was a book that he co-authored with Carlos Lara and Dr. Bob Murphy called The Case for IBC. You can find that at infinitebanking.org. It's a 7-chapter book, a little summary of a lot of Nelson's thoughts. And we're on chapter 5 today called How Does This Work?
Absolutely. And this is, this is an interesting chapter, Nick, and it's interesting when you search on the internet and find some of these guys out there that are on YouTube, et cetera. They spend so much time talking about the insurance contract. And so we're going to talk a little bit about it and have just they kind of handle some FAQs here. And so let's just kind of get into it. So, he talks about that we're using a properly designed dividend paying whole life insurance to become your own banker, right? And then he just jumps into the questions. And I agree with some of the ways that he answers the questions, and we're going to add some things or maybe add a little bit different twist on some of the answers, okay? So the first question is, if it's about becoming your own banker, why do you guys keep talking about life insurance? So it's infinite banking concept, right? It's transforming the way you think. And here's what I would say. It's a process, not a product. Okay. Yep. But we're going to talk more about the product here with these questions. Okay. And it's the insurance contract is a money pool. And it's really, you need a platform, you need a money pool to make infinite banking work. Right?
Yeah, just remember, everyone, this is not about a product. It's about a process. I always say, hey, you can do this with your shoebox money, a CD, your checking account. Just so happens that the ideal platform is this very specifically designed dividend paying whole life policy. And there's a lot of people out there on the internet trying to just sell the insurance policy, sell an illustration, make that thing kind of tricked out. But Nelson belabored, hey, don't get focused on that too much. It's about the process.
Absolutely. So, he says in the last paragraph that in order to practice IBC as Nelson envisioned it, it's necessary to make large premium payments to build up cash surrender value of a life insurance policy so that large policy loans will be available when needed. Okay. So, this is something that we want to put more in here, not less. This is, you're going to utilize it, put it to work. So that's what I would say is I'm going to take away from that first question is it's the vehicle to becoming your own banker, and you want to have a bigger vehicle or a bigger pool of money, not a smaller one. All right. Question number 2. What if I'm uninsurable? Can I still practice IBC?
Of course.
Of course. Now, you have insurable interest on people that you may not realize that you have insurable interest on, but your spouse, your children, to some extent, your grandchildren, there is legacy planning in life insurance, and could be business planning, business partners. I mean, Nick and I have insurance contracts on each other. I'm sure that there'll be more policies on each other as our joint ventures grow. Bob Burnett and I have policies on each other. Harper Jones and I have policies on each other. Those are just some of the people that create Tailwind that we have policies on each other.
Yeah. So it's just think of it like this. You can't go insure somebody else's car that you don't have any ownership of or any loss. It's just, hey, if something happens to Jim, I have a loss in our business. I have a solution, a problem that I need a solution to, and the death benefit from the insurance company will help take care of that problem.
Absolutely. And here's kind of the cool thing is, what if Nick and I decide we don't want to be in business anymore, do I get to keep the policy on Nick?
Yeah, absolutely.
Absolutely. Right. So, it's about, I like his example in here versus the Ferrari versus the Honda Civic. Is if you have a Ferrari, then you can insure, you're going to insure the Ferrari for a lot more than the Honda Civic, right? So, all right. Question number 3. Doesn't everybody know that life insurance is a terrible investment? All the investment experts say you should buy term, invest the difference.
All right. Before you go on and really have a lot of fun with this, I want y'all to know, if you want to watch a great analytical video on this, less than 10 minutes long, that picks apart this, reach out to us at createtailwind.com, hit contact us, put that in the note on the message, and I'll send you a link to a video. Requires a password and whatnot. But if you really want to see this laid out, we'll send that to you.
Yeah. So here's, I got to disagree with Bob Murphy here. Okay. It doesn't happen very often, and I'm not going to debate economics with him. Okay. But Dave Ramsey and Susie Orman are not investment gurus.
Yeah.
Okay. Number one, they're entertainers, Bob. And if you ever revise this book, I would strongly encourage you to put in there investment entertainers, because they aren't gurus. They aren't advisors. They're entertainers. Okay. But also, you're comparing a guaranteed savings vehicle to an investment, and it's not an investment. The definition of investment is what, Nick?
Yeah. A risk of loss.
That's right. A risk of losing all of your investment. Right.
Yeah.
Okay. So, buy term, invest the difference.
Yeah.
It's really funny because, 33 years ago, that's what people would say. Should I buy term, invest the difference? And all these UL gurus would say, yes, do that inside of the insurance contract. It's called universal life, and it's failed twice in 40 years, but you should still try to do it. And whole life has been around since the 1650s, and it's never failed, but you should try this other thing. Right. Okay. We'll get back to that. All right. So, the bottom line is, if you're 25 years old, you have no money, and you're not thinking long term, then term insurance sounds pretty good, because you can get a 10-year term policy for basically nothing, a 20-year policy for, again, relatively inexpensive premium, right? But in a 30-year, still not going to cost you very much money. Why? Because your chances of dying between 25 and 55 are very slim, less than 1%. But go try to buy a 30-year policy when you're 55. So this isn't a permanent solution. This isn't a protect your family, pass down your wealth, anything else. It's a scarcity mindset. When I buy term insurance, Nick, am I betting with or against the insurance company?
Betting against them.
Betting against them. And what do they have on their side that I don't?
Actuarial science. They got all the information.
They got all the data, right? So they know I'm not going to die. At least 100,000 of me or whatever aren't going to die if I'm between 25 and 55. And they know that they don't have to charge me very much money for that 1 out of 100,000 that's going to die, or whatever the number is, right? So go ahead, Nick.
I think that this whole buy term, invest the difference, this notion, it completely misses the point. And he says it politely in here. You're comparing apples to oranges, and it's the concept, buy term, invest the difference. It's the notion of giving up control. You're going to go sit down with a money babysitter and say, hey, do what you can with my 10% savings, invest, quote unquote, invest that, put that money in prison. Okay. Because you're not going to be able to mess with it. All right. We're talking about you taking control of all of your money, because what did Nelson ask? He said, is your need for death benefit or your need for finance greater?
Need for finance.
Your need for finance is greater. So how about we solve that? Because Nelson's book, Becoming Your Own Banker, is really about solving one problem, and that is that we finance everything we buy. So buy term, invest the difference. We're not even in the same universe of comparison. It's not even apples to oranges. It's apples to tractor trailers.
Right. Absolutely.
So anyway, we'll send you the video if you really want to see the math on it, but it's conceptually there, it's totally different.
Now here's another thing, is uh, some people like to put large term riders on IBC policies, right? And he even mentions this as a sophisticated approach. But I would tell you that if you're doing infinite banking, I prefer having a separate term policy that is convertible. Now, somebody might in the audience might say, well, my agent told me that my term rider on my IBC policy was convertible. Is it convertible?
Technically.
But what is, if I convert it in the first, whatever number of years, at least in the first 7 years, what's going to happen?
The policy will become a modified endowment contract, a MEC.
More than likely, right? But how many people have you heard on the internet say that, hey, I put a large term rider on there so I can protect their insurability and protect their family?
Yeah. And all those people that we're seeing out there doing that, they're really new in this game.
They're really new. That's right.
They haven't gotten to the point where their customers have tried to do that and they realize they couldn't, and they're going to be really ticked off. They're going to find out later on that there's a problem. So
again, what I'm trying to say is, I'm not saying you shouldn't have term insurance to make sure your family's protected, because you should.
Yeah, absolutely.
While you're growing your IBC system, but you should make sure that that term is convertible to more IBC policies as you grow this, because once you learn this more and more, you'll want more and more policies. So when you have something that's not convertible and you've tied up your insurability, guess what? You're not growing your IBC system, not for a number of years, right? Yeah. Okay. And one actuary that calculates it says it's 7 years after the last PUA payment.
Yeah.
So what, so again, the MEC rules are changing. So I'm not going to get really into that. And as we've talked about, as of 1/1 of 21, the 7702 is changed, IRC 7702, which is the definition of life insurance, because of the guarantees inside the contract are different and are lowered starting going forward. Then again, if you have a policy that says 4% guaranteed, then it's 4% guaranteed, but they can go down to 2% after 1/1 of 21, right? Does that mean every insurance company is going to do that? No, but they can, and that will move the MEC line, right? So I don't want to go into that too much, because this part of it is really obsolete because of the change in the law, right?
Yeah.
Okay.
Next,
let's go on to the, we can talk about, again, this is a savings vehicle versus an investment. And you can't do a comparison because there are no guarantees in an investment. And this, a specially designed insurance contract has strong guarantees. All right. Let's see. Here's something else I got to mention, Nick, on this, because he talks about internal rate of return. So you have, when you do infinite banking, okay, you have internal rate of return of the insurance policy. If you're buying cash flowing assets, then you have the rate of return on those cash flowing assets as they appreciate in value and hopefully offset inflation, which we all believe is coming, right? Is here and growing, I should say. It's going to continue to get worse, is what I'm trying to say. Then if there's cash flowing assets, or it's a business that's generating a profit, which is cash flow,
right?
Well, then you have a rate of cash flow. So you have a rate of return inside the insurance contract, a rate of cash flow, and a rate of return on the appreciating asset. Plus, this is life insurance. So you have death benefit protection. So you have a legacy return, meaning someday you're going to graduate from this world and somebody's going to get a big check, right? So that's a lot of rate of return. Now, how do I compare to that to a mutual fund and some term insurance that's temporary?
I don't know where you begin.
It's not okay. So I'm going to get off of that, because I could probably spend 30 minutes just ranting on that one thing.
I figured that's where we were going to start, right there, was with that rant.
Well, I just wanted to, and when he says gurus in here. I mean, what makes Dave Ramsey a guru? He's an entertainer. He will not give you advice. And where did Dave Ramsey make most of his money? In real estate. But what you should do is listen to him and buy his term insurance from his term insurance agency that he owns, that he refers you to, and then to Wall Street. That's why people love him on Wall Street, because they're making money. Are you? No, we'll see. Okay.
All right.
All right. Question 4. I heard that those sneaky insurance companies keep your cash value when you die. That's just not even a question that I've heard in the last 10 years, I don't think. So I'm not sure that that's a frequently asked question. But what would you say to that, Nick?
I just say, hey, we don't need to belabor this. It is fundamentally not understanding the insurance contract if you say that. And I do know that the Dave Ramsey world likes to perpetuate that because it's throwing dust up in the air. But just think about this. Let's say that you had your home paid off and you sold it. You got $500,000 for your home. You get the check. And then you say, no, I'm staying here. This is still my house. You don't get both. And if you just think on that, if you didn't follow what I just said, just hit the 30-second rewind button and listen to that again. But it really is that simple. This whole life insurance policy, it's an asset. Think of it like that. It's not a commodity. You're not renting term insurance or anything like that. It is fundamentally completely different. And it is more akin to your home than it is anything else, or a business entity than anything else.
Absolutely. All right, let's jump to question 5. IBC is really just a way of to build up wealth in an asset and then borrow against it when you need liquidity. But there's nothing special about life insurance for this. I could just as easily do IBC using my house and home equity loans from a regular bank. Now, I've heard this maybe, again, I don't get this question, Nick. I mean, we don't get this very often. I mean, maybe I've heard it a couple of times in the last 10 years, but I mean, where would you start on that?
I would just say, hey, it's understanding what's going on behind the scenes. And there's really 2 things going on. It's understanding the loan process. Okay. It's, hey, when I want a loan, we don't apply for a loan. Hey, if we want a loan to buy a home, they ask us all kinds of questions. It's a 30-day process at best, right? They want to see pay stubs, tax returns. Just where do I even begin with that? Then you're going to sign 30 pages of documentations. If you bought a home recently or refinance, they schedule an hour-long meeting with you to review all these documents. But if we want a loan from our insurance policy, hey, we're calling right now saying, hey, we want you to send me money, and they're going to do it. There's no application process. They don't ask when you're going to pay it back. There's nothing like that. It's already pre-engineered to allow you to be able to do that. That's part of the contract. The second piece is all those other things you borrow against. You could be removing money from a policy, like we hear people, or from an entity. Like when you take a loan against a qualified plan, your money actually leaves. If you're borrowing against your home, the value of it could go down. The bank could call the note. There's peril there. The insurance contract, it's guaranteed. There is a guarantee inside of that. The value of it is not going down. So it's a really safe thing to borrow against. And most importantly, your money doesn't leave. You don't interrupt the compounding when you take the loan. So that would be the extent of my soapbox on that.
Yeah, I mean, I'll summarize it to it's who's in control too. Yeah. I mean, it's the bank's in control when you try to use a HELOC. You're in control when you use the insurance contract. You're the owner of the contract. You're the owner of the policy, not the insurance company isn't the owner. You don't have to ask permission because the owner makes the decision, right?
Gotcha. Yeah, good.
All right. So how about if the economy crashes, won't life insurance companies go down too? Well, I mean, think about this. Okay. I mean, remember I said that insurance companies have been around since the 1650s in England, right?
Yeah.
Okay, have there been hard times since the 1650s, Nick? Have there
Couple
been
seasons
have
of
there
hard
been
times.
catastrophic economic conditions? Maybe like I don't know, the Great Depression, when thousands of banks failed. Right now, we have no problem putting our money in banks. Why would we ever put our money in banks after the Great Depression? Well, because we trust again, right? We believe that the government's regulating these banks, and guess what? They're regulating the insurance companies too, just a lot more stringently. But during the Great Depression, what saved a lot of people?
The insurance companies.
That's right, the insurance companies, the cash values in their insurance contracts, right? So the other thing is that when we look at Exter's pyramid, right, is what do the insurance companies, and that's on you'll see it in this chapter, but it's, if you look at, they basically they invest in the middle of the pyramid, right? So muni bonds, corporate bonds, that's long-term stuff, right?
Yep.
And if they had a 40-year bond strategy, which is hard for you and me to do, Nick, then 40 years ago, what year would it be? 1981, right? Okay. Now, were you alive in 1981, Nick? Just barely. Okay. So, I'm just kidding. In 1981, I was 16 years old. But in 1981, interest rates were high. Now at 16, that didn't really affect me, right? But we still have some bonds that are from the 80s, is my point, right? So there's some things there that really help the insurance companies, and they have reserves, and he doesn't really go into that. But I want you to look at something here, because they always say, if everybody does this, then how would the insurance company survive? Okay, so what does it say on the percentages in the table that they have? Table 2, distribution of U.S. life insurance assets in general, and in general account year in 2015, 3.2%
of policies have loans out on them.
Now think about that. Okay. I mean, 70% is in long-term bonds, what I just talked about. 70%. Okay, so you got 10% in mortgages. So it's really interesting. Now, here's something I would just tell you. Okay, those percentages of total assets, they don't add up to 100% on the right side in this book. So some analytical person is going to figure that out. And I don't know what the answer to that is, because the only thing that I could think of is that the corporate bonds, something's wrong with that number. Because I'm sorry, total long-term bonds. Okay, you know what, Nick? It's me that's wrong. I'm adding wrong.
Yeah, there's subtotals in there.
There's subtotals in there. Okay, I'm like, wait a minute, this doesn't add up. Okay, I get it. I didn't think those guys would make that kind of mistake. It's early as of this recording, early in the morning, and I've only had half of my coffee allocation. Okay, I get it. All right, I'm thinking something's wrong, but there's not. Okay. All right. Anything else to add to that, Nick?
No, let's keep moving, because
yeah.
Here's question 7. If the commercial banking system is vulnerable, as you've explained, then why would it be safe to keep my cash in an IBC policy? Doesn't the life insurance company keep my cash in commercial banks? How can I get a policy loan if the banks are all closed?
Right. Okay. So, you could, what would you say to that, Nick, before I go off on a rant that I won't go off
I think we just sort of covered where all the money is kept. But the second thing is, hey, you're kind of talking about an Armageddon moment where there's no on and off ramps. We still use a commercial bank for an on and off ramp. So they're still there. We're using the commercial bank as a bank of convenience. But we're just not storing our money there.
Yeah. I mean, if it basically, as long as there was one bank standing, you'd be okay. right? Because you could have the money transferred to that bank. So, and if all the banks went out of business, then you know what, folks, we got a lot bigger problems than you can imagine. It's going to be about what you're going to eat, not about your retirement. So,
I think the central banker's got a plan that's not going away anytime soon.
right, exactly. And so let's just put it this way: the insurance companies are much safer. Is a much safer place to store your money than a bank, right? Okay. So question number 8: if I'm worried about price inflation, then isn't life insurance a bad place to keep my money? I want to avoid dollar denominated assets if I think the dollar might tank. What's your thoughts on that, Nick?
Well, I think it's kind of missing the point of the process of banking, because what do we talk about all the time? Hey, you take this money and we deploy it for cash flow assets, right? That are going to keep or outpace inflation even. That's kind of how we think about it. We don't think about it in terms of, at least our clientele is not how we talk with them, is that we're going to just take money, we're just going to store it there and hope that it grows and the guarantees are there. That's not the point. That's not
what we're doing.
We work with. Yeah.
We're buying assets. So, if those assets are still there, also, you think about it, is when you're buying, if the dollar fails, well, does that mean that our currency system will be failed for months, weeks,
overnight?
It'll be days at the most, right? Okay.
Yeah.
So what if Congress changes the tax rules governing life insurance?
They just did make a tweak to it.
Yeah, they just did. And it's you're going to be able to put more money in the insurance contract. Gosh, I wonder why they did that, Nick. Could it be that some of these yahoos that are supposedly our representatives in Congress are doing this? Well, that's one reason, right? We know of at least 54 elected officials at the last counting. Now, I would guarantee it's probably more than that. And the two individuals that happened to be running for president last time in 2020 both do this, right? So that's number one. Number two is there's really no reason for them to change the life insurance laws. It's only when they're abused. And when they were in the 80s, they were really being abused by stockbrokers more than insurance professionals, right?
Right.
So you can read in that chapter 9, but the bottom line is, even if they make changes, they've always grandfathered the policies that you have. Okay. The changes in lowering the guarantees going forward, that doesn't affect the policies that you bought before 1/1 of 21, right? Those all are going to be in it, and it may not affect the policies that you're buying going forward. I mean, we're selling policies today that still have the higher guarantees.
Yeah. Yep, exactly. All
right. Why do you insist on implementing IBC with a whole life policy? Couldn't you become your own banker with universal or other permanent life insurance policy? Okay. So could you? Yes. Would you want to? No. Why? Well, a universal life policy, like I said, has failed twice in 40 years. I would say that I've seen thousands of these, thousands in 33 years. I've never seen one variable universal life, index universal life, plain old vanilla universal life, guaranteed universal life that has that their cash value is more or even the same as it was projected when it was sold. When you get to be 65 or older, and that cost of insurance keeps going up and up and up and up, Nick, and your cash value has a correction or it's flat or whatever, it doesn't work. And is infinite banking all about the insurance contract?
No.
So if it's not all about the insurance contract and it's about your behavior and it's about the process, then why would you want to use a product where failure is an option? And universal life failure is an option. In whole life, it's guaranteed and it pays a dividend. If they never paid the dividend, you still get the guarantees. That's not how universal life works.
Yes.
Anything to add to that, Nick?
Yeah, I always think of it like this. So before ERISA was enacted, it seemed like everyone and their brother had a pension plan, a defined benefit plan. Okay. So who took the risk in that? Well, that was the employer, right?
Yeah.
And if you worked there for 30 years or whatever it was, at the end, they promised you a distribution of X amount. Okay.
Yeah.
Then ERISA came along, the IRA and the 401k was birthed. Defined benefit plans went away, and we had this rise of the defined contribution plans. And what did that? It made retirement, quote unquote, retirement plans a DIY project to the employee.
That's right.
Okay. So I look at it kind of the same. The whole life policy is like the defined benefit plan, where the employer, the insurance company, takes on the risk of performance, and the universal life is like the qualified plans, and that the employee or the purchaser of the policy takes on the risk. So to your point of, is failure an option or not? Well, I believe that failure just became an option when I buy a universal life policy, just like your 401k versus the defined benefit plan. So that's how I keep it straight in my brain.
Yeah, I like that analogy. And by the way, when you do it yourself retirement planning, do they give you training when you join that company? Do they tell you, hey, here's how to become a pension manager?
No, they tell you to go line up for a money babysitter who isn't paid to make you money.
But hold on, why don't they want you to be educated?
Because then there's no way you would participate in the system.
So think about that. Do governments, does the stock market, do banks want you to be uneducated? Well, yeah, you're the perfect customer then. You need them. You're dependent on them. But if you're educated and you bring the banking function to the you and me level, like Nelson tried to educate people for years and years and years about this, well, then you don't need them, right? Then you're in control. You have the knowledge of how to take control of your life, the banking in your life, and the investments and the savings and assets in your life. You get out of the rat race. You break away from the herd,
hey,
right?
Jim, are the qualified plans a government program?
They are.
What did Nelson say about all government programs?
Name me one that has ever succeeded. He would say, he would list them. The post office. I mean, he'd go on and on and on. By the way, Nick, the thing that drives me crazy is the Department of Education. It is the most massive, or one of the most massive buildings I've ever seen. What does it do?
I don't even know.
I don't know either. And there's a lot of people working there and they're getting a paycheck. And if there's anybody in the audience that works at the Department of Education that can explain to me what those thousands and thousands and thousands of people do, give me a call. I really would like to know. All right.
Hold on.
Question 11.
One last thing, because I
one last thing
that said this about the government programs. He said all government programs end up doing the complete opposite of what they were intended to do. So I just want you to think about that. When you're thinking about this retirement plan, just think, is it really going to work out?
Is it going to build my wealth?
To do. Yeah. So anyway,
what's the opposite of build your wealth, Nick?
All right. Last final question of the chapter.
Okay.
This one makes a lot of sense. This makes a lot of sense for people who are younger / older than me. Famous question we get all the time. Am I too old for this? Or, boy, I wish I would have known about this 10 years ago. We have a lot of laughs about those comments.
Yeah. I would go back and I would ask one thing that Jesus asked. And Jesus asked, do you want to be healed?
Yeah.
Do you want to be healed? Well, would you want to be healed when you were 80 or 20? Well, yeah, I'd rather be healed when I was 20. Would I rather have started doing infinite banking when I was 20? Sure. Okay. But I didn't have the means that I have now to do it. And you know what? When I'm 80, I'm going to have more means than I have now. That's just the way that I'm running my life. Right. So, By the way, I had a 24, 25-year-old guy the other day say to me, he's a bright young man. He said, man, I wish I would have known about this sooner. And I wanted to say, excuse me, you're 25 years old. But and he was doing very well at 25, by the way. But here's the thing. We've seen people in their 80s get started doing this. Now, are we putting the insurance on them? No, go back a few questions. Right. They had a lot of people that had insurable interest on. Now, and again, at 80, Nick, are you still going to be thinking long term?
Yeah, absolutely.
You know, with your 4 kids, you could have about 16 grandkids by then. Oh my gosh, that scares me.
Well, you think about this. Just go back to what we're solving. We're solving that our need for finance is greater than our need for death benefit.
Well, that if I'm too old, then I don't have a need for finance, right?
Right. When are you going to stop spending money, Jim?
Well, it's the same day that I'm going to retire from Create Tailwind is when you see my obituary, then you'll know that I'm retired.
Yeah. So everyone's not too old.
By the way, I will truly be retired. Then I'll be taken out of service.
There you go. But here's the thing. I always say, if you agree that being your own banker is the right thing to do, okay, there's no way it could be too late, because it's never too late to start doing the right thing.
Absolutely. All right. Well, this chapter, Nick, I don't even know if I should say this, but it's not my favorite chapter in the book.
It's okay. It meets some people where they're at, and that's okay.
But I hope that we've answered some questions that people might have, because we really, what we get. Here's the questions we get: how do I get started? Why wouldn't somebody do this? How are you guys going to coach me? Why? I really want to coach. I realize Tiger Woods, maybe that's a bad example this week, but the best golfers in the world, the best football players in the world, the best business people in the world, they all have coaches.
Yeah.
And that's what we do. And so they want to know, well, how are you going to coach me? And, those are the questions we really get, because once somebody reads the book, they watch some of our videos, they listen to some podcasts, they go, okay, I want to do this. This is something that is going to change my life, change my family's future, and leave a legacy. And it's biblical. I want to do it.
Yeah.
Right. And then they just want to know, all right, what are the things that I should be asking that I haven't asked? And what are the pitfalls that I haven't seen? And that's where we come in and we help you with all of that. And if you go to createtailwind.com, you can get a lot of great information, all for free. You don't have to meet with us if you don't want to. And if you do meet with us, again, we're not going to throw you down on the ground and twist your arm behind your back, only because we're going from Zoom. If we were in person, we might do that. No, just kidding. And we just educate you. We just show you what's really happening. And Nelson always said, Nick, if you know what's happening, you'll know what to do.
That's right.
So any famous last words, Nick, before we wrap this up?
No, thank you for doing this. And I think thanks to Nelson, Carlos, and Bob for putting this book together. Just remember, you can go to infinitebanking.org and go to the bookstore on there. You can get a copy of this. And we appreciate you listening. And we've got a couple more episodes in this series, and we'll move on to some. We have a great guest lineup coming up.
Absolutely. And, folks, you have to break away. What's the alternative? Stay in the herd, stay in the rat race. That's no place to live your life. Until next time, I'm Jim Oliver. Thank you, Nick, for joining me. Thank you, audience. Be sure to subscribe to our podcast and rate us at top. What is 5? Is 5 the top, Nick?
Yeah. And it's
I think it's only 5 is what you're allowed to rate breakaway wealth. No, I'm just kidding. Thank you, everyone.